Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to This Peak Prosperity Podcast. I am your host, Chris Martenson, and today I'm going to be fielding reader questions with Adam Taggart. Hi, Adam.
Hey, Chris. How are you?
Good. Well, this is part two. I understand that we've got more questions. Actually, we barely made it through a third of them from last time. So what else is on our plate for today?
Better question is, what is not on our plate? We've got lots of questions across a variety of topics here, but why don't we just dive right in? Are you ready?
I am.
Okay. And the first one's not an easy one. This comes from user Doug. The environment seems not to get as much focus on peak prosperity as the other two E's. Is that going to change, especially in regards to addressing climate change? Those
are two separate questions for me. The environment, I believe, we do give pretty decent coverage there. Obviously, we haven't, solely focused there, but we've recently had things on GMOs and the wheat incident that happened out of Oregon and what's entailed there. We talk regularly about things that are happening in aquifers. We talk about soil farming, water issues. We're pretty well covering those things. I don't believe that we give a huge weighting to the global warming piece, although we have, I think, one of the better threads you will find anywhere on the net right now that our very own Dr. Mark Cochran is hosting for us. And we do have an open discussion around it. We don't make, I personally made a choice a long time ago not to make global climate change a centerpiece of how I wanted to engage and talk to people. So a lot of our work here, Adam, as people here know, is to spread the message and to engage more people. And let's be honest, talking about these big changes that are coming are not easy topics under the best of circumstances. In the prior podcast, we talked about how difficult it is to talk to friends, loved one, coworkers, spouse, even about something as relatively easy as, say, risks that might exist in the stock market or what the Fed's doing. These even are difficult topics. And one of the things that I learned, this came from our work, remember when we were talking with Dan Ariely, it was a number of years ago, and behavioral economists have worked out some of the fundamental underpinnings, how we're wired as organisms in terms of how it is that people either will or will not undertake change. And we know that most people are wired to go through change after experiencing some form of pain rather than insight. And so that's one learning. And then another learning is that in order for people to really want to change, a number of things need to be there in place. And one of the most important ones is to have a sense of control, a sense of agency. That is, if I feel like I'm being presented with something for which there is no solution, my tendency to take concrete action around that might be low. As well, it helps if the thing that we're talking about is very concrete. It's easy to get your hands around. We're wired as organisms to respond to threats that are near and immediate in preference to threats that are farther and more distant. And so for all of these reasons, what I found early on and what working with you and with all the other people at our site is confirmed with all of the thousands of success stories we have where people came across some information that's insight, chose to change around that insight, take action, do concrete things like install solar panels or start gardening or maybe move or to a more resilient location to begin engaging with their neighbors, to take these very concrete steps. Those are all things that I think people would be and should be doing, whether they believe in global climate change as a story that's an organizing principle, whether they believe that economic difficulties might lie in our future, whether they believe that the energy story tells us that we will have to learn how to get by on less, whether they just want to do this for quality of life reasons because living more simply has its own large advantages and living a more engaged and resilient life have their own advantages. Whatever reason somebody wants to go down this path of becoming more resilient in their life, I truly believe that it's in our best interest to find the easiest, most gentle path to have that conversation. That is, if I could tell 3 different stories and each one of those stories would result in somebody putting up solar panels on their house, I'm going to prefer the easiest route that I can take in telling that story because it's the action that matters to me, not the why people undertook that change, but that the change and the concrete steps got taken. And so for a variety of reasons, guess what? In looking at the global climate change story, it's a very difficult one to present in a way where people feel like they have any control at all over the story. That is, even if the United States decided to completely stop emitting carbon tonight, I think everybody in their heart of hearts knows that maybe China would step up to fill that void pretty quickly. So even our national sense of control is low, and it's a distant threat. And it's as compared to some of these other things that are coming down the pike much sooner. In my heart of hearts, I believe that we're going to run into economic chaos well before we run into full-blown climate chaos in a way that really is going to prove disruptive to people's lives. I think we'll hit an energy wall well before we run into any other larger problems down the road. And let's be real. These are predicaments. They're very real. I fully support if somebody finds it to be their organizing principle and is what they care about, that's absolutely something I support. And in terms of the mission of the site of trying to reach more people with what we think is already a reasonably difficult story to tell, this narrative of change, that there are ways to do that where we can get from point A to point C in the easiest possible way. And this is hopefully not sounding controlling or Machiavellian. It's just that we've learned that if you have in this business, it's not just what you say, and it's not just how you say it. It's also when you say it, and trying to control for all of those pieces. It's felt to us like that the actions that people have taken. I think anybody who really cares about global climate change would look at the actions that people take as a consequence of going through the crash course and related materials and say, yeah, those are the right things to do. And I think they make sense on all these dimensions and many more. Job security, national wealth, health. There's a whole variety of reasons that these are truly, I think, the right actions for people to be taking. So that's a long-winded way of saying we've looked at it, just have not decided to make it a centerpiece for a variety of reasons. Did that make sense?
It does. It does. I think the only additional things I'd underscore there are, as I think you said, the steps in which we would take on both an individual level and a policy level to address things like peak oil, which we spent a lot of time focusing on, are pretty much a lot of the same steps you'd be taking to combat climate change anyways. So to your point that it's the actions that really matter, we find that by our current focus on steps for dealing with resource depletion and specifically peak oil, we're already presenting a lot of the steps that we would if we were wrapping the climate change banner more tightly around ourselves. The second thing I'd add is that it's not a verboten topic on the site at all. Again, you mentioned Mark Cochran's excellent thread, and we will be bringing in some voices from the climate change discussion as time goes on. I think we've talked about inviting Bill McKibben on, and we may indeed invite a few other folks like him on in the future. And lastly, you talk about the ease of discussion to have when you have options, and we've certainly found from history on the site that climate change is still one of those topics where people bring a lot of passion and a lot of entrenched beliefs into the discussion, and we find just for whatever reason, it's one of those discussions that people have a hard time having without emotions getting inflamed in getting in between the constructiveness of the dialogue. So, again, it's not a discussion that by no means we're avoiding or prohibiting on the site, but it's just one of those things that we find the deeper we wade into it directly, we tend to have unintended consequences there, which is just one more reason why we don't fully wrap the site's focus around climate change. But everything else you agree with made total sense to me.
Absolutely. And we will be looking at it and continuing to assess the data as it comes in. And, just personally, last year I lived through the hottest year on record that we'd had in this region. And a lot of people at that moment were saying, well, this is full confirmation of climate change. And this year we lived through one of the coldest ones. And so I agree that there's a degree of chaos. And if this chaos goes across our food-bearing regions, it could be really obviously a very large game changer at this point in time. But it's very, very confusing to figure out what's happening, at least locally, that whole don't confuse climate with weather piece. But it's been a very, let's say, fast-moving story to try and get our arms around that. Science is constantly evolving. What we know is evolving, and it's a very chaotic system. So with all of that said, we're going to keep our eyes on it. In terms of making it more central, I think it's about where it's going to be for a while at the site.
Okay, great. Well, let's move on to another question here. Is there a scenario in which the U.S. avoids a 3E induced hard landing? This is somebody, I think, trying to be hopeful here.
So the realistic answer is no. The unrealistic answer would be sort of Mr. Smith goes to Washington, but this time really changes things. There would have to be a huge wholesale changing of the guard, as it were, of our way of thinking. You know, it was interesting. The Post-Carbon Institute recently just spent some of their valuable time, and they went down and did a tour in Washington, D.C., and came away pretty much confirming, our views around here, which is that there's not really enough time in the daily life of a senator or congressperson to even attend all the meetings on which they happen to be committee members, let alone really fully digest everything. They depend on staffers. It's an interesting machine going on down there. And the short answer is they came down talking about how the shale gas revolution may well be much more short-lived than anybody is potentially hoping. And they found almost no traction for that idea because they were coming with data, and that's not really part of the conversation down there yet. So realistically, are we going to avoid a harder landing or some sort of disruptions around this? The answer for me is no. We're going to, this is, again, I'm parading beliefs here, but I believe we're going to have to wait until a crisis comes, and it's going to have to be pretty serious. Because note, we had this 2008 crisis. That was as serious as I could imagine. Then into 2009. And in terms of the structural reforms that resulted in terms of our spending policies, bank regulations, the too big to fail breakups that didn't happen, nothing really substantive changed. So even that wasn't a large enough sort of a moment to really begin to talk about things in a realistic sense. So from the totality of the three E's, where are we on having an honest energy conversation at this point? Nowhere. And in terms of the environment, it's just as bad. So my view, we're going to have some sort of a crisis, and in that crisis, there's a lot of different ways it could go. And the important work that I think we're doing here right now is to lay the groundwork so that when that time comes, we can start to have the kind of conversations we really need to have. And that's work that, thankfully, we've still got time to do it. Thankfully, we haven't entered the next stage of this crisis yet. And so that's the gift from all this money printing is giving us the ability to, really start to hone the ideas and work through them and polish them up at the site and in our conversations and in our minds so that when the next crisis comes, we can really start to talk about what we actually have to be doing.
All right. I think the only thing I would add there is because we're not facing reality as a collectively right now, and until we start having those adult dialogues that you mentioned there, we're basically digging the hole just that much deeper. And so the reality is that we are going to have to take our medicine. We essentially are going to have to take our lumps. We lived above our means for a while. We're going to have to live below them for some time to correct things. So just from my perspective, I feel like the hard landing is actually the best case scenario. There's a lot of opportunity there for a harder or very much harder landing, and I think those are the ones that we really want to try to avoid with the progress that you're referring to.
Absolutely. So here's just a case in point. I was just reading the newspaper today and looking at auto sales, and they're worried that they're leveling off, but they noted that the bright spots in the auto sales figures for the past 6 months or so have been in light trucks and SUVs. And so one of the stories that we're telling ourselves with all this shale oil that's coming out of the ground is that, actually we're at peak demand because we're going to be burning less because our fuel efficiency is going up so much across our fleet. And then I look at the actual light vehicle sales numbers, and I see that we're actually buying some of the least efficient vehicles out there. So the idea that we are in any way, shape, or form grappling with this predicament in an adult-sized fashion, as you say, it's just we're not having that narrative and discussion yet. So we will, but it's gonna take something more than we've got, and hopefully, I guess the hope is it's just a hard landing and not something a little bit more rugged.
Okay, all right. All right, next question comes from user Cowtown.
Okay.
Do you have a recommended asset allocation at this time? They comment that, personally, as you've mentioned, your high percentage of holding gold in terms of your own personal gold stores, and you've shared that percentage in the past, they're not sure is right for everyone, which I think we would completely agree with. So what's your reaction here?
Oh, yeah, I know the exact precise portfolio that everybody should have. You should have the portfolio that allows you to sleep well at night. And that's what my portfolio does for me. I sleep like a baby. I have absolutely no concerns about the direction of where things are going in this larger story of fiat money being overprinted. I'm reasonably confident that gold and silver represent ways to protect my purchasing power. I'm very happy every time I spend money that either improves the soil fertility, the energy efficiency, the water redundancy of my property. Those all just feel like lock-solid investments to me at this point in time. But as you mentioned, everybody's situation is different. So whether your age has a huge bearing on this, your risk tolerance, how much capital you actually have, these are all things that people have to take into account. Listen, investing is a tricky proposition, I think, under the best of times. These are the worst of times. We were just talking with Bob at Portola, one of the recommended advisory firms today, and he was mentioning that in his 30 years in the business, this is as treacherous an environment as he's ever seen. It's impossible to really fully understand what's happening next because we're all depending on what the Fed is or is not going to do, what the ECB is or is not going to do, what Japan is or is not going to do at the central banking level. And so that really speaks to the idea that the portfolio that you need is the one that you feel safest with. And for that, you got to trust yourself. Everybody's going to have a different opinion about this. Some are going to believe that we've got many business cycles between here and whenever maybe some larger catastrophe in the dollar system will arrive. Some might think that's coming sooner. Some are going to find that their gut is telling them that they would much rather be in physical, tangible assets than financial assets. Some will have the opposite point of view. So for everybody listening, figure out what you believe in and then find yourself a trusted financial advisor who can help you execute that strategy. Because my belief, this is a time to stick to your guns. Get a theme, analyze what makes sense. Don't get whipsawed, which is so easy to do in these markets, by the daily gyrations of whatever's happening with respect to prices or policy decisions. If you just back up 3 big steps and say, where are we going on this? Listen, we live beyond our means for a while. We have way too much debt. Energy prices are high and likely to stay that way. This is just a bad combination for typical tried and true financial investments to return great profits over time. So instead, it's time to start really thinking more carefully and picking stocks very carefully and individual investments, be that at the local level or in your own homestead or with somebody you know, picking those very carefully and really knowing what you are getting involved in. And for me, given the demands of my time at the website, I don't have time to do a lot of that or any of that at this point in time. So I'm perfectly happy right now, me, being invested in gold and silver and cash at this particular junction in time, and also in my homestead. And those are my big areas where I keep most of my liquid net worth at this point in time. And that's me. So again, find somebody you really think you can work with, trust yourself, and get yourself the portfolio that will allow you to sleep well.
Great. And for those folks that haven't heard us mention it before, given the large demand from people that have watched the crash course, really like the framework, and are looking for financial advisors that share a similar perspective on the future, we've taken the time over the years to identify a couple of firms. If you're interested in learning about them, just go to the front page of Peak Prosperity, scroll down to the resources section. You'll see a section there for endorsed financial advisors, and there's more information to learn more. All right, we have a couple of other investment-related questions that we can hopefully bang through here, Chris. No particular order. One is, are Roth IRAs safer than traditional IRAs?
Safer in what respect?
I'm not entirely sure.
Well, that would be a great question to run by a financial advisor. My own personal view is I have not been contributing to IRAs for many, many years. And the reason for that is that I have a belief that tax laws can and will be changed in the future. Obviously, we've been seeing all sorts of laws get changed, including the Cyprus bail-in, the MF Global mysterious ruling where client accounts were just taken, and who knows why that was allowed to not be criminally prosecuted, to who knows what. The Roth IRA is just another form of a 401k where, difference is putting money in after tax rather than pre-tax. And on both cases, whether it's a traditional 401k or whether it's a Roth or even a 521 college savings plan, what we're counting on is that when we want to use that in 10 years, 15, 20 years, whatever your horizon is, that the rules will be the same when we get there. And I'm not confident of that. I'm pretty convinced that, as we talked about, the final conclusion of this is living a much lower standard of living that is below our means for a while. And that's going to involve higher taxes and fewer return services from government. That combination feels pretty solid to me at this point. So I've had a strong personal bias towards having my money not in vehicles that require future tax treatments in order for them to make sense to me today. But that's me. And I know they make a lot of sense for other people. And that's something that everybody has to make an individual decision around with their own financial advisor or somebody they really trust.
Yeah. And for the record, too, I follow a similar path as you. I stopped contributing to my retirement funds largely for the same reasons a number of years ago. I just reread the question. The question really had to do with confiscatory risk. If the governments do decide that they need to raid pension funds, is there something about a Roth that makes it a little bit less likely to be accessed by a government in distress than a traditional IRA? I think the honest answer is there's nothing that I know of for sure, and if you do, chime in. But otherwise, as you said, I think it's best just to talk to a financial advisor with that question. But all my knowledge tells me that there's really not anything really special about a Roth IRA that gives you any additional protections.
Not that I'm aware of either.
Okay, similar question. For those with money stuck in retirement funds, and those often come with limited options for what you can invest in, what should we be doing right now with markets so elevated?
Well, I've been an advocate of the idea that markets are elevated kind of under false terms at this point in time. I think nobody would disagree with this statement here. If the Fed suddenly stopped their QE efforts tonight, the markets would fall and fall heavily. That is, they're inflated, and they're being inflated through the actions of a fairly dedicated, what would I say here? I think the Fed is it's in for a penny, in for a pound. They've certainly got themselves backed into a corner. Yes, they're absolutely committed. So I think one line of thinking would be, well, I'm just going to count on them keeping that level of commitment going forward. I think that's probably a fairly safe bet. However, personally, if I were in a position of having money in the stock market at this point in time, and I had the capability of either taking that off the table at this moment in time and watching and waiting to see what happens, or at least buying some protection in the form of puts against that, so that if the market did go down, you'd be protected in some way. That's my personal view, because I have this piece out, wrote it in February, said that I think there's a reasonable chance of a fairly significant market decline by fall based on fundamental things, such as corporate earnings are at all-time elevated levels. They're probably going to have to revert to the mean. We've got all kinds of new pressures bearing down on consumers. We're starting to see some of that leak into the data. So fundamentally, it looks to me like the economy is not yet roaring off, cleared the tree lines. It's, the wings are still at or below limb level on the nearby forest. And it won't take much to upset that. And meanwhile, stocks are priced for perfection, and also bonds are priced for perfection. However, and one of the things I noted in that article, and I've noted recently as well, is the idea that junk bonds were, and I'm using this now in the past tense, at all-time record high prices, that is, record low yields for junk bonds. This is CCC corporate junk. And those have started to reverse course a little bit, and we're starting to see leakage also in the Treasury market. So this is actually pretty profound. The 10-year Treasury went from 1.69 to 2.2 in just about 8 or 9 trading days. It was in percentage terms. I know 2.2% is not a lot, but going from 1.7 to 2.2, it's actually quite a lot in just a few days. And so we're seeing these early signs that bonds are starting to leak a little bit, and I think we're also seeing topping signs in the stock market. So both of those together are just caution signs to me. They're yellow. They're not bright red yet, but they're flashing yellow. And so were I to have money in the market, either it's in a 401k or some other place like that, I would certainly be thinking about thanking my lucky stars that I'd had my money in the market while it ran up to all-time new highs, and maybe backing away for a while as we watch what happens.
Okay. So it sounds like now's a good time to consider getting to a higher cash percentage in your IRAs. The only other thing I would mention is if you have a 401k through work, oftentimes you'll have the ability to talk to your plan administrator, and you can actually convert part of that 401k to a brokerage account. It's still managed on a tax-deferred basis, but it does give you the opportunity to purchase a much wider array of securities. So if you wanted to be a little more defensive by actually making some investment bets that way, you can. Again, this is not personal financial advice. It's just letting you know that you have more options oftentimes than just the 4 or 5 plan options operated or offered through the traditional 401k.
Absolutely. Or if you can get to your financial advisor, if you have your 401k under management, just tell them to move some or all or whatever you feel comfortable with to cash at this moment in time as you wait and see.
Okay, one last retirement fund question here. This comes from Tyser. Retirement funds can be liquidated for up to 60 days without penalty if the money is put back in. Will there be a milestone at which you'd advise folks to liquidate their holdings for short-term safety? So I guess what he's saying is perhaps if it's in reference to this potential large market correction you're looking for, do you foresee a time at which you might actually issue, say, an alert that says, hey, everybody, things are so dire, or seem like they're going to get so dire, you might want to pull your money out of your retirement funds just to have it in hand, and if I'm wrong, put it back within 60 days.
Larger question lurking under that for me is it really depends on what percentage of your assets they happen to be. I still have money in a 401k. It's legacy from my time at Pfizer and SAIC. It's maybe 6 or 7% of my total net worth, and it's sitting in a 401k. I can't imagine any scenario under which I would say I need to pull that out under the scenario that Tyser's mentioned here. And that's because by the time I'm pulling something out, first of all, it takes an extraordinary amount of paperwork and time to be able to actually execute such a maneuver like that. I've certainly learned in rolling over 401ks and moving funds in and out of them, it's just a time-consuming process. So if you're imagining that there's something like October 2008 happening again, it's a very fluid environment. It's going to be exceedingly difficult to actually get things to move from point A to point B. So here's the thing. If your 401k is a significant portion of your assets, you're going to want to start having a harder conversation about whether you want to have, and I'll make a number up here, 50% or more of your liquid net worth tied up in a vehicle which is fairly illiquid. Illiquid in the sense that you might have liquid assets in it, but it's still illiquid in terms of your ability to get your hands on it. The rules could change on it. In a real market crisis, it could be difficult to get to. So for anybody who has a significant portion of their wealth in a 401k, I think you need to start having these sorts of conversations with your financial advisor, which is, do I have everything in place so that if I wanted to, I could pull it out for this 60-day grace period if I felt I got into that position? That'll be an eye-opening conversation for a lot of people. You think this is your money? Wait till you try and get access to it. There's a lot of forms to sign. There are a lot of different steps that have to be undertaken. Secondarily, where would it move from and to? Most of these plans, some of them, do not even have a way of getting you your money electronically. They cut a check. Ooh, we're back in the 80s, right? If you do have the electronic funds transfer, you have to get that set up in advance ahead of time, and you actually have to ping it at least once so that it works. So you would be able to move it in a free-floating environment like we're talking about, a potential crisis. The short answer after all that is, I have not yet seen anything that was extreme enough, even in 2008, that would have told me to tell somebody to take those steps. Is it possible we could get to that? Absolutely. But it would be a fairly significant global systemic financial/banking crisis. And once we're in that particular environment, either you have already got your ducks in a row to be able to make those sorts of maneuvers, or you haven't. And by the way, if you have more than 50% of your liquid net worth or total net worth in a 401k, you might want to think about ways, depending on your age and other circumstances, to think about ways that could be reduced, or to, as you and I did, stop contributing and parking assets elsewhere if you're still in that mode. But there's certainly some things that you have to think about. I would personally be very uncomfortable if I had 50% of my net worth in a vehicle where I felt I couldn't get liquid access to it.
Okay. There probably are a lot of people listening that probably do have 50% or more of their assets in a retirement fund, so I don't want to spook them too much. But one thing I will underscore that you said is, if you think this is a step that you may take at some point in the future, particularly if you've got a good chunk of your net worth in a retirement account, as Chris says, you may want to, while things are still working relatively the way they always have been, before a crisis arrives, take out a nominal amount just to go through the steps, as Chris says, just to make sure that everything is set up, that you know what you need to do, so that if indeed a time were to arrive where you felt you needed to take the step, you're not doing everything for the first time, and you've reduced your probability of negative surprises, of finding breakages in the system when you really need to rely on it. The other thing I'll mention, too, really briefly, is there are people that hold precious metals, physical precious metals, inside a retirement account. I have heard of people who have been able to take delivery of those precious metals, and as long as they are returned within 60 days, they avoid the penalties as well. So, if instead of getting a check during times of duress to sit on, if you actually wanted to hold and then get delivered to you precious metal that was being held initially in your retirement accounts, that is possible. Again, all these things are things you need to be talking about with your financial planner, but did want to let people know that is possible. And
absolutely, again, if the first thing in this story is always to make sure that you've gone through the necessary steps to figure out exactly what's required to move money out. And Adam, you made an important point. It's not just investigate them and read the words and understand what the steps are, but you have to go through the process once of actually take $1 out or something, some nominal amount, just to see that it works, because there's always learnings. That's been my experience.
There's always Murphy's Law. There's always the unexpected or unplanned.
Always. You thought you did everything, and they say, oh, well, we didn't have that form on file at the home office, or something. Who knows what, but that's been my experience so far.
Okay, great. All right. Next question. This one comes from user Kathy P. What's your opinion on holding savings in a credit union versus a commercial bank?
Well, credit unions operate quite differently. They've been relatively safe. They're a different ecosystem from the commercial banking system, and so are savings banks, and so are cooperative banks. They're all different ecosystems. Once you're in an ecosystem, say it's a cooperative bank, or in this case a credit union system, you're going to want to look at that particular institution very carefully. There are services that rate them, and I've always been comfortable, myself with institutions that are B plus or higher through the Weiss rating system, or Bankrate also has a system which gives you sort of a 3-4 star kind of a deal. But for me, I'm always interested in being with very sound institutions. The credit unions, I'm not familiar enough with them to know that on a state by state basis how they're really managed in terms of the insurance system that goes on there. But here's my general philosophy on banks and whatnot. Keep your money spread in a variety of accounts. Never get over the limits for what are currently insured. And be prepared to move money between accounts rapidly if you think the institution you're involved in is in difficulty. And never get involved with a bank or institution that's got a C or lower grade. Or a 2-star or lower grade in these ranking systems. There's something else called the Texas ratio, which is something that feeds into many of these ranking systems. You can look at that. There are a variety of ways that you can tell bad institutions from good ones, but there are flaky institutions out there in any particular banking or credit union ecosystem. So know your bank. The ones I'm involved with are extremely sound and well run, and I truly believe they will be more immune to whatever next crisis comes in the next bank. And, that's where things stand right now.
Okay. If I could restate what you said, and maybe add a few words that you can either validate or not. Obviously know your bank, that no matter what type of bank you put your money in, that's key. Second, it sounds like it's good to diversify amongst things like commercial bank, savings bank, credit union. They all have different models. So just like you diversify with stocks, diversifying your savings among different banks is probably not a bad idea. It's probably not a bad idea just in general, because you're diversifying just by having your savings in a multiple amount of institutions. So if any one goes down, the others will hopefully be there. Is there anything to the savings bank or credit union model in terms of a benefit that you don't get at a commercial bank that you like?
No, it's just that you're attached to a different system. So I do have one large commercial bank, have some accounts there. The large commercial banks are all sort of tied together. So the thing I'm unclear on is what happens if there's suddenly a derivative accident for Jpmorgan. my belief is that a lot of the commercial banks will sort of get swept up in that. And I could envision a scenario where potentially the commercial banking system shuts down, but the rest of the ecosystem is still operating, and other parts. So the only one that I'm really aware of that truly seems different to me is in Massachusetts, where I live. The cooperative banking structure has its own charter, has its own insurance, it's just offline compared to all the other banks out there. And they've never lost a penny, even through the Great Depression, back when things were uninsured at the national level through FDIC. They still had their own cooperative structure that served them then. And they're just exceedingly cautious. They are the model of what I would call a regional bank, these cooperative ones. They're just 20% loan to values, knowing their customers, very cautious, and certainly not ever involved in any of the highfalutin subprime derivative kinds of behaviors that I think are just an accident waiting to happen.
Right, okay. So bottom line, probably not a bad idea to diversify your savings amongst the different types of banks out there.
Yeah, and there's still some very, very well-run banks out there. Most of them regionals, community level banks. Okay,
great. All right, let's see here. Any specific advice for EU residents?
Yeah, don't have your money in a Spanish bank.
Yeah,
or a Greek bank.
Or a Cypriot bank.
Portuguese bank, or Cyprus, or Ireland even, I hate to say. There are still, the situation in the EU looks to be more and more like it's headed for some sort of a breakup at some point. And I know that's being avoided at every possible turn, but the underlying structural weaknesses that gave us the snow in the cornice to give us the first avalanche of this crisis, those have not been changed. The snow is still falling, as it were, in this metaphor. And, we're seeing with the unemployment levels in Spain and Greece and Portugal, when we're looking at the increase in civil unrest around many of the austerity measures that have been imposed, when we're looking at the level of bank loans failures and things like that, I think it seems fairly likely that there will be some sort of a breakup or dissolution. Maybe not, back into individual countries, but certainly maybe north from south, or maybe one exit or two here or there. But still, I'd be prepared for that. And the idea, so there are huge imbalances in the banking system over there. We've talked about it before with the Target 2 imbalances, and the ECB is doing everything it can to keep it all balanced. But if there is some sort of a Greek exit or a Cyprus exit or a Spanish exit or whatever happens to occur, that's really going to wreak havoc in the banking system over there. So same advice I would have over here, which is make sure that you are keeping your primary assets in your country of residence as much as possible. Understand that capital controls might be part of the future. Make sure that you're involved with banks that are as least exposed to that huge dynamic that we're talking about. I would, again, have very strong personal preference for smaller banks rather than the gigantic banks that have footprints in all these different countries. And so, that's at least just from the financial side, that's certainly something I would be keeping aware of at this point in time, because the genie's out of the bottle. They've already said what they're going to do over there, which is they're going to do bail-ins, they're going to tax wealth if necessary, and all of this will be to preserve the banking system and structures as they currently exist. And European banks are more levered, have done less deleveraging, I think are more exposed than U.S. banks at this point in time.
Yeah, Kyle Bass has really sounded the alarm bell on that one, too. So I would agree with you and maybe even be a little bit more directive and say, I would say even more so than our U.S. listeners, if you're living in the EU, I would be taking some probably not too insubstantial amount of my net worth and trying to get it out of the banking system, whether that's just going to cash, whether that's probably even better is precious metals. I think the case for owning precious metals is probably even better if you live in the EU. The banking system there, like you said, is fraught with all sorts of risk, from freeze up to a Cyprus type haircut for safe quote unquote money that's just on deposit in the bank. So I would make sure you've got some percentage of your holdings that is just not in the banking system. Yeah, and precious metals again are a great way to do that, where that's the one asset class that you can hold in your hand and nobody has any claim on.
Absolutely, totally agree with that.
Related question to the EU is: are we planning on doing a London seminar anytime soon? I'll answer that, which is no. We don't have one on the calendar. We were over in London last fall. We don't have any immediate plans to go there again soon, but that could certainly change. I think one of the questions was what sized audience would need to get us over there. I think the quick answer to that one is there's an opportunity cost to this travel. When Chris is on the road, he is not writing. So, I'm guessing we would probably need a seminar audience, probably at a minimum of about 50 or so people. Ideally, we'd like it a little bit larger than that for the dynamic of the seminar. But to answer the question, I'm going to put that down as sort of a minimum threshold.
All right. Sounds fair.
All right. And then interesting set of questions here from Poet. How does your advice around building resilience change, if it does, for the following populations: the poor, the elderly, the infirm, and minorities?
Well, the primary thing, the most important thing that you can do, and this is something Adam and I have talked about quite a bit, it's not going to be the financial crisis that's really going to unnerve people and really do them in. It's going to be the response to it. And so the most important thing that anybody can do, whether they've got all the money in the world or whether they've got no money, or even worse, they have a negative net worth situation, is to work on their emotional resilience. And one of the best ways to do that, of course, is to have community. I truly believe that whether you've got, unless you're the truly, truly, truly wealthy and you can just buy anything you need, everybody else is going to be as safe, as secure, as happy as they are in terms of the depth of their community relationship. So, again, whether you're in an urban setting or you're in a completely rural setting, knowing the people around you and knowing them reasonably well, having undertaken any sort of steps to have engaged with them, whether that was as simple as a barbecue, or maybe it was doing some projects together, or maybe it was even just did a potluck. But that's going to be the most important thing for anybody, wherever they happen to live, is being able to both lean on people for support when you need it and to give support. Both of those things have very, very high value. And I know we talked about this in the past, which is that sometimes it feels it's so much easier for me, the way I'm constructed, to give than to receive. But in the community building aspect, being on both ends of that transaction in equal measure is really important. And that's certainly something I need to work on, because I find it much easier to be on the giving side than the receiving side. This is what I would be doing regardless of where I lived or what my personal net worth was. And interestingly, having lived in a very rural, very poor area of North Carolina, having been a rock climbing bum, lived out of a van for a year at one point in my life, decades ago, I know that that for people who have relatively little, there's already a culture of sharing that's very, very different. And so honestly, I think that it's middle class on up who have the most work to do in terms of building community and learning what it means to really be reliant on the people around them, as well as to allow people to give and to also be able to receive in that setting. So that to me is going to be the most important thing, regardless of your circumstances. And big part of that emotional resilience is just being aware of what's going on, knowing what's possible, so that when it happens, it's not that you don't have to work through that shock phase of going through the mental exercise of letting go of these things that we think we have or we own, understanding what's truly valuable and important. It's time. It's your relationships. These are all things that I think come into sharper relief when the moment is poignant, but it's honestly something that we can work on anytime, anywhere we happen to live, and should be.
Yep, and if you're working on strengthening those relationships, whether they're within your local community or whether they're even within your family, no time like the present to start working on them, and the stronger you get them before the crisis, the more natural the help is going to come during a crisis. If you wait until the crisis happens to start looking around and knocking on doors and whatnot, the dynamic is very different.
Absolutely.
All right, so our last stretch of questions here, and congratulations, we are seeing the light at the end of the tunnel here, are questions about the precious metals. I'm going to try to collapse a couple of them together here. First one is, how surprised were you by the recent drop in precious metals prices, the one that started about a month ago?
All right. Well, I was pretty surprised, just like most people. First of all, it was not just an unusual drop. It was an 8 sigma, once in 30 years kind of a drop. It was really very unusual. I was not surprised at all that such a magnificent drop was not investigated by the CFTC or the SEC. And part of the reason I was surprised was I have not seen a more gold-friendly environment in all of my years, given the bail-in that happened at Cyprus, looking at an entire continent of Europe suddenly realizing that their wealth held in the banking system is now exposed and at risk, looking at the degrees of monetary printing going on across the world, but with Japan fully doubling their monetary base in the next 2 years, seeing China just absolutely start consuming not just a little bit, but way more, probably 60% of all the newly mined gold in the world is going straight to China, and there's an extraordinary amount going straight to India as well, and seeing other central banks start to accumulate rather than dishoard their gold. These are all very, very clear, obvious signs for why gold should be in a bull market, if anything, or in a very price-supportive environment. So seeing it suddenly get taken out to the woodshed like that, yeah, that was surprising. At the same time, I've been watching these things for years and years and years, and I know that when the big bullion banks get a giant concentrated short position, somehow the price always ends up going down. And wash, rinse, repeat. They've done this so many times, and they know they can do it. They have complete impunity and immunity. Nobody's ever going to investigate them, and they know that, and they make money doing it. The interesting part of this story, though, is that as the bullion banks play their little shenanigans and scoop money off the table as they execute these bear raids on the precious metals, one of the things they can't control is that when they drive the price down, it's almost like it's a commodity or something, demand goes up somewhere else. And the amount of demand from the East at this point in time is so startling that I truly believe sooner or later the West is going to have to come to terms with that particular dynamic. And I don't know how they do it besides let prices rise, but the other alternative is kind of an ugly scenario to me where they just shut the gold markets down because they'll make something up, pick some excuse. Was I surprised? Sure.
Okay. Nate adds a follow-on question there, which is there a price at which, for the precious metals, at which you would advise folks accelerate purchases? And possibly, should mining stocks be part of the mix? Is that an asset class that you might feel comfortable recommending given the right circumstances?
Well, so for the first part, listen, there's the price at which you buy gold if you don't yet have your core position, by which I mean you've identified a number. Call it 10% at a minimum, but maybe it's a higher percentage of your total net worth where you're going to be, you want that in gold, and that's you just go out and buy it at whatever that number is. Just go get it. I don't think there's a right time that you could possibly do that. If it's a big enough number, you might want to break it into 4 or 5 different purchases. Put the purchase dates down on the calendar, and then just go ahead and pull those out and buy your gold then and silver. So otherwise, like if you're saying, well, now I want to increase my percentages, the levels that we're at right now, this whole 1,300 range to 1,400 feels like perfectly good range to get involved with it. And here's why. Aside from all the other fundamental things I just talked about, there's one more, which is that the average cost to extract a new ounce of gold out of the ground is about $1,200 worldwide right now, and it's climbing for a couple reasons. Inflation in the mining industry is double digits, and that's across all mining industries, not just gold and silver. And secondarily, ore grades are going down. And so there's just some fundamental reasons why it's just getting harder, more costly to get gold out of the ground. And so to me, the marginal cost of production is your floor for the price of something. That's why I'm convinced oil's not going below $80 a barrel anytime, because that's what it costs now to get it out of the Bakken play or Deepwater or something like that. Now, the miners, I used to be a big miner investor, and I backed away from them a while ago because I didn't like some trends in the industry, which they're starting to clean up. They were dilutive, which I felt was abusive to shareholders. They would just issue, equity all the time. I did not like the fact that cash flows from operations were stagnant, even in some cases declining, even as the metal was doubling, tripling, quadrupling in price, which is their prime product. That's a bad sign. They've started to clear these out. We're starting to see those occur. So yes, I think that miners could be a reasonable asset class to be invested in. It would just be one of many if I was going to have equity plays. But let's be clear, for the past 3 or 4 years, mining shares have been rather poor, in general, have been rather poor ways to take advantage of the rising metal price. In some cases, you were doing better holding the metal itself. That means they're highly risky plays, and they are and they're not even leveraged. In fact, some cases they're reverse leveraged, if that's possible. So for these reasons, I think that if you're going to get involved in the miners, again, do your due diligence. pick them carefully. I love some of the majors. I love some of the dividend yields that they're putting out right now. I think that they've cleaned up their cash flow from operations. It looks like the CEOs and the CFOs have finally figured out they can't abuse the shareholders and through dilutive practices. So they've cleaned up their act there. So there's a variety of reasons that I'm personally, I have one eye half open on the industry again, and I'm thinking about starting to really pour through and think about how to pick some of the ones that might make the most sense to put in a portfolio here.
Okay. Two things. First, on picking mining stocks, I don't remember the exact fraction, but it is a ridiculously small one of the number of at least junior mining ventures that actually get to production stage. So it is an extremely risky industry, and you really got to do your homework, as you're saying. One analyst that we think pretty highly of is John Duty, so I'd recommend anyone who's interested that hasn't listened to it to listen to your interview with John Duty from, it was about a month and a half ago. And he runs a newsletter that covers gold miners called Gold Stock Analyst, and he produces a top 10 list. And I think that's a great place to start if you're looking for candidates. To the first part of the question that was asked, that Nate asked about, is there a price at which we would say, hey, look, back up the truck on precious metals? I think the answer is sure, that could happen. It's going to depend on a number of factors, many of which we track regularly, very closely here at the site. So if we do see the planets align in a certain way, we're definitely going to share, our thoughts and insights with the Peak Prosperity audience if we think there's something exceptional going on. And as an example of that, when we had this 8 sigma drop in the price of gold and silver about a month or so ago, we were talking daily with a lot of the major bullion dealers to get a sense for how inventories were doing, because they were getting very tight. And one of the things that we learned and heard from a number of them was, particularly with silver, if the price of silver drops to 20 or below, they're pretty much saying it's going to be game over for inventory. It's going to be very, very hard to get inventory. And while theoretically you might see a spot price of silver in the teens, you will not be actually able to buy it for anywhere near that. And we got a preview of that a month ago when silver got down to 22 or so. And yet, if you're going to buy it, you were buying it at the $28, $29, $30 level. Well, that's all the time we have for Chris. There were a couple of questions we didn't get to. I'm sure we're going to do this again in the near future. But congratulations, we made it through.
Well, fantastic. I'm looking forward to more questions. These are great questions, and it's been a lot of fun answering them. So I hope we get to do it again soon.
All right. We'll talk to you then, Chris.
All right. Thanks, Adam. Bye.